I want to appreciate you all calling in. We have about an hour today to discuss our current outlook and what we see in the markets. I will turn it over to Adrian to do the introductions and to set up the format for the call. Thank y'all.
Great. Thanks for being on. This is Adrian. I run our multi-asset group. I'm here with Matt Lockridge, who runs our value equity group. And we hope to give you some insight as what are the primary economic impacts and the potential paths going forward. I believe at the end of the call, we will have some questions we'll try and answer for you, and certainly reach to your contact at Westwood for any further questions you might have that you think we might be able to help with. Just starting at the top level, we do think this is a very different economic impact in nature than that of previous economic events that led to a market correction. We are experiencing now something that we've termed the consumption void that's leading to the usual economic engine in the United States, which is consumption. That's 75% of our contribution to annual economic output, grinding to a halt. So considering how much economic impact we're going to see is a little bit of a question of how much economic contraction does this lead to each quarter, and a whole lot of how long is this consumption void going to continue. On the how much near-term output contraction we're going to see, we're already seeing, and that's the first thing that we would see, is negative impacts in unemployment reports in the last 2 weeks. Those are probably some of the best high-frequency indicators that we get. We are currently forecasting unemployment rate in the second quarter near 15%. That's from a low of around 3.5% ending 2019 and higher than at any time since the Great Depression. It truly is as if we were going 100 miles an hour and hit a brick wall. Usually economics theory, or Okun's law, estimates about a 2% loss of economic output at gross domestic product, or GDP, for every 1% increase in unemployment. While we don't think we'll see a 30% loss in economic output in the second quarter, that's given a 15% unemployment expectation, the loss will be dramatic and sharp, which is why the central bank and government have acted so strongly and forcefully with the aim of helping consumers and businesses bridge that consumption void. Unfortunately, the latter question of how long it is going to continue is the hardest one to answer. We do believe, looking at the three parts of restarting the consumption engine from a virus scare, are number one, having a fast and comprehensive testing program so that I have confidence venturing out into communal areas where others are tested and clear, or going into the hollow tube of an airplane where I believe others are tested and clear. Several companies are purportedly very near this stage of having the ability to produce 5-minute tests or other tests that might actually test the population well and quickly. The second stage would be treatment solutions, so getting the mortality rate of the virus down to something like seasonal flu levels, so I have less fear of infection. And at least one pharmaceutical company is likely to have shortly some results on a potential treatment. That's in the next month or two. That doesn't mean that we'll have the treatment. It just means they're going to have results of that. And then finally, the last stage would be vaccination, so it's not transmissible to the vaccinated. That testing and producing the many millions of vaccinations required is likely to be the longest stage. So until that happens, until you're comfortable back out and going to the movie theater with your family, then we're still certainly going to see some impact. At current, our central expectation is for an activity resumption in the latter part of 2020 as the infection rates drop with warmer weather and the large-scale testing I spoke about, and hopefully treatment options emerge. Some degree of pent-up demand from people like myself that can't wait to get back out into the restaurant at this point, and unemployed coming back from furlough will lead to a reasonably strong bounce in economic output. We don't see an immediate recovery to previous levels of high economic output from where we were, low unemployment like 3.5%, and by consequence, back to the previous market valuations in the near term. Real economic damage has been done and is being done. And a contraction from we had the longest economic growth cycle in history that will naturally lead consumers to tighten their belts regardless, delaying purchases, increasing savings rates until we see more clarity on where we are in the cycle. Finally, the fiscal and monetary policy help that we have seen from the U.S. government is extraordinary and beyond anything in modern history by orders of magnitude. in very short order, we have enacted 9 programs to keep the market orderly and fiscal spending programs that are going to help us bridge the consumption void for at least the second quarter. That doesn't just mean things like unemployment insurance, so you're comfortable going out and consuming. It means for those small businesses that are able to now make their rent and some of their loan payments and their utility payments, we're helping them do that until consumption comes back online. A faster virus solution will certainly be very positive for markets, while a slower solution leads to probably additional fiscal help from the government, i.e. another package, leading to some support for markets that is from dropping significantly from here. Evaluations go down, but at this point, the government has been so reactive and anticipatory in economic data that should we need further fiscal help, we're going to produce more fiscal help. If you're interested in a slightly more detailed layout of our outlook and the positive and negative scenarios, please do reach out to your contact at Westwood, and they should certainly be able to send that to you. In addition, of course, we're looking at companies and sectors, and the outlook leads to areas that we can avoid and opportunities. My colleague Matt Lockridge is here to talk to you about that. All yours, Matt.
Great, thanks, Adrian, and good morning, everyone. This is Matt Lockridge. Well, COVID-19 is having a very broad impact across most sectors of our economy and the markets. In fact, the way we're looking at exposure across the sectors we cover is really not if a specific area is being impacted, but more of a by how much mentality. When looking at some of the hardest hit areas so far, obviously airlines, cruise lines, some of the areas driven by discretionary spending are getting lots of attention, and rightly so. Just this Friday, Delta released an 8K forecasting their second quarter revenue is now expected to be down by 90%, 90, year over year. So obviously that type of sharp, dramatic fall off in revenue is putting the whole industry into financial distress. Now, obviously commercial airlines are an important part of our domestic economy. They allow for commerce as we know it to flourish. But the airline industry employs about 750,000 people directly. But there's really another industry at the epicenter of this crisis that has a much larger impact to our economy, and that's the restaurant industry. Restaurants employ about 13.5 million people directly and is in a state, frankly, of free fall right now. We're starting to get better data on the industry to paint a picture of current trends. Restaurants with a significant percentage of their business that's dine-in are seeing the biggest declines, as you would imagine. And based on our analysis, we expect many of the public casual dining companies to see revenue down 60 to 80% over the next several weeks, with the shutdown of their in-restaurant dining only partially offset by an increase in delivery and carry-out orders. Now, fast food or quick service players will see less of a negative impact, but they're likely still to be down in the 20 to 40% range year over year. In many cases, the majority of their business was already coming from the drive-through, which remains open, and many of these industry leaders were already investing heavily before the crisis into their own delivery apps, which should help blunt some of the decline, but traffic will still be down significantly for this cohort as well. Additionally, we're starting to get some good data out of the international markets following the explosion of COVID there in markets like China and South Korea. These quick service players are starting to see early signs of a recovery, but we would caution that the data has been volatile. It really varies region by region, and total traffic levels are still not back to pre-crisis trends. So unfortunately, this is leading us to believe that a V-shaped recovery in restaurant traffic here in the States is less likely. Our base case assumptions for domestic restaurants here in the US are for 4 to 6 weeks more of the current state, meaning dine-in traffic is closed, followed by a slow recovery when containment measures are lifted. And restaurant traffic is likely to remain below pre-crisis levels for the second and third quarter of 2020 and get back to a more normal trend late in the year. And this will obviously vary based on the given business's strength of their off-premise sales. So with restaurants as an example of one of the hardest hit areas, we also wanted to walk through a sector that's actually seeing a bit of a benefit, and that's consumer staples, specifically the food and household products companies. So we get scanner data every few weeks, which is point of sale trends at retail. And if you look at the 4-week period ending March 21st, which is the latest data available, sales trends have really jumped given the stock up patterns that we're seeing across the country. Food broadly was up 35% year over year, with certain items like soup up over 100% year over year. Bread is up 40%. Salty snacks like chips are up 25%. And then in personal care and household items, you're seeing numbers like toothpaste up 45%, detergent up 51%, and bleach up 50%. So we're clearly going to see a number of leading food and household products players show revenue acceleration. And on the margin front, we're seeing some puts and takes. First, trucking prices are up on a spot basis. And if companies are having to ship items to less efficient locations because, for example, a plant is closed, that's going to add some pressure on costs. But lower oil prices will clearly help, and they're going to see some fixed cost leverage from the acceleration in sales. And further, what we suspect many of these companies are doing right now is they're canceling all future promotions. So this is going to reduce logistics complexity. For example, if they were running a special with special pack sizes, for example, that adds operational and manufacturing complexity. They're going to remove those, which will allow them to run their manufacturing lines essentially one line 24/7, which is the most efficient way to run a facility. And the vast majority of these businesses, especially in food, have been deemed essential by the government. So they won't be sitting idle, and they can really max out their manufacturing efficiency to help their margins. We also don't think this is a one-time benefit, just a stock-up benefit, especially in food. If we see restaurant traffic remain low for an extended period, this will help food at-home sales. And to put a finer point on the magnitude there, longer term, there's generally been a 50-50 split in spending between food away from home or at the restaurants and food at home. But food away from home is generally 2 to 3 times more expensive given restaurant markups and the margins that they have. So if we assume that restaurant traffic is going to be down 60% for an extended period, that would be a natural 20% lift in food at home sales on a longer term basis. One additional point here on food, what we're watching, after the global financial crisis, we saw the percentage of private label food increase as consumers traded down during that weak economic period. And we're really watching for the same phenomenon here. As the economy moves into a weaker spot, we suspect private label food will increase its market share. So restaurants is on one end of the spectrum, seeing massive negative disruption, while food and household products are on the other end of the spectrum, actually seeing some benefits. Other sectors seeing more headwinds than tailwinds include auto suppliers, home builders, industrial distribution, oil and gas companies, department stores, and apparel companies, to name a few. Other areas seeing some positive impacts include the dollar stores, club stores, the pure e-commerce players, and drug distributors. So let me pause it there and hand it back for questions.
Matt and Adrian, thank you. This is Marty Brainerd. I wanted to let people know that we will not be able to open it up for Q&A, but I did have some client questions that I wanted to present to you all. I will start with Adrian. Adrian, what effect will the massive government stimulus have on our deficit, and how long will it take to dig out of this enormous hole the spending will create?
Great, thanks for the question. That is a good one. And still a lot of uncertainty as far as, the biggest question of how long is this going to take before economic activity comes back online, which then leads to around tax receipts and revenue for the government to have the ability to pay debt. I don't think to say that this blows a hole in the budget is too strong of a statement. Obviously, economically, the U.S. has been procyclically spending or increasing the deficit in good times. So we're caught in a crisis on our back foot to start. Even before the coronavirus, the budget deficit was rising. It increased to about 25% in the last 12 months, and the national debt has increased to around $23 trillion. That's more than 100% of our debt to GDP. The massive government stimulus that we have done is absolutely necessary, and even more maybe necessary, as I said before it's done, in order for the economy to continue functioning in a way that allows us to avoid a depression scenario and truly continue our way of life. But yes, with the $2 trillion fiscal package, $2 trillion plus, the deficit will double this year and is likely going to stay high again next year. That deficit will take the national debt from around $23.5 trillion today to around $29 trillion next year, in a time where economic growth is likely to be lower than average. So near term, more deficit spending will be required to bridge that consumption void. Medium and longer term, we're either going to have to grow at a faster pace. That's not our central expectation, or we're going to have to tighten our belts further to prepare for the higher expected taxes in the future in order to pay down our debt. There's a whole economic theory around this on Ricardian principle and things, and it does hold true that we are going to be thinking about how we pay down our national debt, or finally we simply print money in order to pay down our debt. There's an emerging school of thought known as modern monetary theory, or MMT, that usually ends in bad outcomes for emerging market nations that have tried this, but that's a potential for us. What all this means coming together is that the heightened deficit and debt loads are certainly going to create a natural balance against resurgent high growth from the fiscal program. It is absolutely necessary, but it means on the outset of this, we do expect to emerge from the crisis on a slower than average growth path for at least the next 5 years.
Adrian, thank you. Matt, a question for you. Last week, we hosted a call with Strategis Research Partners, and they indicated that certain industries have performed better coming out of the last recessions. They suggested that those industries were entertainment, aerospace and defense, airlines, metals and miners, consumer financials, and transportation or truckers. In your opinion, will it be different this time?
Sure. So typically, if you look back at prior cycles, the areas that get hit the hardest going into a downturn are the areas that bounce back first when the market begins to price in a recovery. And typically, the areas that get hit the hardest going into a downturn are more economically sensitive. That's why they get hit. The economy slows, their business slows down, and prices fall. So in the list you just named, areas like transports, consumer financials, and some areas of the commodity complex, I would expect those areas to be some of the first to bounce back. On the other side, though, a couple of those industries that you named could be less likely to lead on the way back up this time. First, there's a massive shift going on right now within the entertainment industry towards more direct-to-consumer offerings and away from theaters and the traditional cable bundles. So depending on where you're invested in the entertainment space, you may not see the typical rebound that you've seen in the past. Another area is, we're spending an enormous amount of money from both a monetary policy and fiscal policy standpoint to fight this pandemic. So future growth in defense budgets could be an area that feels some pressure as we prioritize spending on fighting a different type of war right now. So the defense industry may not see as quick of a rebound if budgets are at risk.
Thank you for that. And along the lines of the recessionary comments, Adrian, I wanted to ask you, how do you parallel what's happening now with recessions in years past?
Sure. Of course, I'll say at the beginning, we're not in recession yet, but our central expectation is that we are going to be in one shortly. To step back, the definition of a recession is 2 consecutive quarters of negative output for GDP growth. We expect the first and second quarters of 2020 are going to show negative output growth, given that consumption void we've talked about. With that in mind, our central expectation is that we will see a very scary depression size number in GDP growth and unemployment in the next couple of quarters. But unlike previous downdrafts or recessions, we can see a pretty quick bounce back up in activity as spending comes back online and furloughed employees do go back to work after the industry shutdown. That said, economic activity is likely to remain muted. The damage has been done and continues to be done. And a historical trend analysis that suggests it would likely take several years to get back to any previous levels of economic activity and employment. And of course, I spoke previously on what the natural ballast is of our debt load that could depress future growth, which is different than the way we have addressed previous recessions and the ballast we've had in previous recessions. In some sense, this does have echoes of the 2008 recession. We see less of a financial markets wobble in 2008, which of course was the global financial crisis. We worried about the downfall of the financial system. The financial system has come into this particular downdraft in better shape, with better capitalization levels, with less concern about the leverage that could cause their collapse. It is different in that this is truly a consumer-driven recession. So 2020, the financial better shape to help us support. It's just the virus is impacting our ability to act as consumers in the usual ways. And with this recession, differing from others, we do believe the government debt load that we have incurred can help us bounce back to some degree of prosperity, but it's likely to be a slower growth trajectory than most post-recession periods.
Thank you. And Matt, finally, last question for you. How likely is it we'll be shopping in malls by the end of this year?
Well, we do think our country will be closer to normal by the end of the year. And this would include being able to go back to malls and other more crowded places. Now, as we begin to recover from COVID-19, there may be regional differences in timing or stages of the recovery. And we may need to prepare for certain areas or demographics to return to normal at a slower rate than others, depending on what the healthcare experts say. But we do think by the end of the year, we'll be able to get back to malls. But we do also think that there could be some longer lasting consumer trends because of this pandemic. First, this experience only accelerates the continued shopping shift towards e-commerce over brick and mortar retail like malls. Consumers are becoming even more used to this method of shopping, and companies will only accelerate the rollout of their own omni-channel efforts as the economy picks back up. So, I definitely think we're going to see continued shift towards e-commerce. And secondly, we think you could see some of the retail-focused REITs. We think you could see weaker cost of capital there following this pandemic. Even some of the more defensive real estate subsegments that focus on the consumer are seeing significant distress. The diversified, more service-based consumer exposure, even that is seeing dramatic pressure. And so, going forward, we think investors may have even more of a skeptical eye on these assets, and that will impact their long-term valuation.
Great. Thank you, Matt. Thank you, Adrian, for your time today. We definitely appreciate it. Thank you to all that called in. And we will be sending out a recording of these comments, but in the spirit of keeping these calls both brief but informative, this will end our call for today. Again, thank you for participating, and have a great day. Thank you all.